you recently put out a article that talks about gold's biggest fire sale in 43 years, perception versus opportunity. It's a really good article. I encourage the audience to go check it out. So just curious in your thoughts on gold's behavior in reaction to what's happening with this conflict in Iran, as most people would think that this should be bullish for gold. Mm-hmm. Gold's been heavily correlated with whether President Trump tacos or doubles down on the conflict, right? You can see the gold price just kind of whipsaw and such with the markets. And so just curious in your thoughts on gold and in relation to this conflict.
Yeah, again, I mean, I obviously have a clear bias and a high conviction. If you can imagine, to get beyond my bias for a second and just look at this in the longer term, I've never been more confident, and none of us at Von Greyers have ever been more confident about gold's longer term direction. And that's not just an apology from Zurich and a gold vault and a private gold vaulting service, but I understand skepticism. You know, for me and many others outside of the gold space, again, especially those in the bond markets who understand credit risk and currency risk, gold really is real money. And central banks have been seeing this. Pre-1971, central banks held 70% of their reserves in gold until Nixon welched on the Bretton Woods system. Today, gold is only 30%, and it will get to at least 50%. Gold is, up until this war, becoming the de facto primary reserve asset. It's the new FX reserve currency, 40% US dollars, 35% gold. We saw central bank gold stacking go up 5x since 2022 when we weaponized the dollar in the last war. We were a proxy war win with Ukraine and Putin. So there was clear de-dollarization trends, there was clear gold stacking trends, and those trends aren't going to stop. But we can't deny what has happened since this war began, this black swan or gray swan, or some would say white swan event. You can't deny that there's been massive sell-offs in gold. We need to explain what's going on, put them into short-term and longer-term perspective without sounding like an apologist. The war sell-offs, and again, this is in the background of, gold loves chaos. What could be more chaotic than the headlines today? Why isn't gold at 6,000 or 7,000? It will be, but why isn't it right now? And this is what I call the great paradox, where you have to sell good assets, like in a margin call in a stock market crash, to pay for the sins of your bad assets. So you sell your most liquid and valuable assets. That's not just an apology or a dramatic statement. The numbers are there to show it. I use a couple of examples. Turkey, for example, which has been stacking gold religiously in the last few years since we weaponized the dollar against Russia, just sold 10% of its gold in Switzerland. It just did a swap. Now, a swap is kind of like a pawn shop. It's swapped. It means it can come back and get it later. They can kind of like putting grandma's jewelry there and then hopefully getting it back. But they just sold 10% of their gold swaps in 2 weeks. That's 60 tons of gold they swapped. That's greater than the 43 tons of all ETF gold sold since the war started. So why is Turkey, which loves gold, having to sell its gold? Well, sadly, it's because 90% of Turkey's oil and gas is imported. And so when you have ripping oil prices because the Strait of Hormuz is clogged, every $10 increase in the oil price is another $5 billion in costs for countries like Turkey. So they have to sell their liquid, most valuable asset to create enough dollar reserves to buy petrodollars. This is how the petrodollar is the tail that wags the dog of the rest of the world. So that's an example of a major sell-off in gold. Of course, that's going to push the price down. The other interesting example I use is Saudi Arabia and the other Gulf states. Obviously Saudi Arabia and the OPEC or GCC nations have a lot of oil, but they also have to import 80% of their food. Their military costs are rising, and a lot of expats with a lot of dollars are leaving those zip codes because of the missiles flying. So there's a major drain of their dollar reserves. And since they cannot get new reserves, they have a lot of oil, but they can't sell the oil right now, and they can't get the same revenues. So these countries, our allies, again, never be an ally of America, have to replenish their dollar reserves because their dollar revenue is clogged. So unofficially, and again, don't quote me on this, but unofficially, and the IMF doesn't have to report it, and Saudi doesn't have to report it, what we're seeing with the flows is probably, and I can't confirm this, so I'll caveat that, at least 45 to 50 tons of Saudi gold has been sold since the war started. Again, not because they want to, but because they're forced to. So these forced sell-offs are really temporary headwinds, obviously, for gold. Obviously, also, at Von Greyerz, we're all about wealth preservation. Our clients are all about wealth preservation. It's all about long-term thinking and recognizing that paper currencies, including the dollar, are just melting ice cubes. In the long run, gold always gets the last laugh. When gold was ripping into the end of 2025, I say a lot of tourists came into the gold space and they wanted to trade the momentum. So they're buying a lot of ETFs, which is the last place you should own gold if you're into wealth preservation. And when they were buying these ETFs, they were typically buying 2 to 3x levered ETFs because they were speculators. They weren't wealth preservation thinking. I understand that. They saw a momentum trade. They wanted to get in. They wanted to lever. When gold was ripping, those leverage trades and ETFs made them look very smart. But when gold corrected during the war, be careful who's over-levered because those ETFs have to rebalance daily and cover their margins. So there's a massive sell-off in the ETF space. The other place where there's not wealth preservation thinking, but speculators are hedge funds. And they were trading on algo trades, riding the gold momentum until this war. When they get a sell signal, they all sell en masse. They're not there to preserve. They're there to make profits and swing trades. So all of these things combine to be a real temporary but real, headwind to gold. For those who understand gold as a wealth preservation asset, as literally life insurance for dying currencies, these are just buy signals. And our smartest clients are picking up the phone and buying more gold into these markets because they're thinking 5 years, 10 years out. And again, I can get into a ton of different data points on gold ratios to the money supply or the gold price versus foreign held U.S. treasuries. We are not even close to all-time highs in gold. We're 50, 60% off. And these pullbacks are just buying opportunities. But the other thing is, and I'll end with this point on gold, gold will be revalued to offset debt. Besant himself, even before Trump was in the White House, wants higher gold prices. We don't have the same fear of rising gold as we did in 2011 or 1980 when Volcker said gold was my enemy, or some other said gold was to the dollar like the sun was to vampires. We actually need to let gold run to pay down some of our debts, to revalue gold. I've written about that too. But all of these forces combine longer term to suggest we're only in the second or third inning of gold's bull market. This is not a momentum trade. Gold is a new superior reserve asset. It's a store of value that's better than even the world reserve currency. So these forces right now in the smog and fog and smoke and oil of war are easy to shake out a lot of people. And bull markets always shake out a lot of tourists. And it's sad. They usually get out at the wrong time. We saw this in the great bull market between 71 and 1980 with gold, where midway through in 1975, there was a major shakeout in gold. A lot of people sold at the bottom and then missed the whole ride up. But again, we're not trading gold at Von Greyerz or those who understand physical gold outside of the banking system as a preservation asset. This is a buying opportunity and not a sales pitch from a gold apologist.
Yeah. So with that important point in mind, how much liquidity do you think people may need in this type of environment? So I know quite a few people there, stacking up on some cash, some T-bills. I've been holding a little bit of T-bills just for liquidity. And then, because gold is ultimately being sold for these nations to get liquid in this type of volatile environment. So just curious in your thoughts on gold ownership, buying gold, continuing to have a long-term outlook on that, but also maintaining immediate liquidity.
No, these are important questions. And again, it's frustrating because I know for many listeners, gold, whether it's at 5,500 an ounce or 4,700 an ounce or 4,200 an ounce or 6,200 an ounce, is extremely expensive. It's hard to just buy an ounce here and there, especially when you look at the status of the middle class, which I call the working poor, this massive wealth transfer that happened in the last 10, 15 years, especially since 2008, when we inflated the QE, we inflated the money supply, we inflated stocks and bonds, and we inflated real estate. But many people realized that they weren't in the markets. They didn't have the real estate. They didn't enjoy that inflation. Inflation is not color or class blind. It only benefits the top 10%. It guts the bottom 90%. So for many who are trying to preserve wealth, they haven't even been able to acquire wealth to preserve. And when you're asking how much gold can I get, how much dollars should I keep in liquidity, again, if I were trying to protect myself longer term, I wouldn't want to save anything past, I certainly wouldn't want a US IOU or Treasury past 5 years out on the duration curve. I wouldn't want anything past a 2 or a 4 year Treasury. I wouldn't want to save in US dollars, even if the DXY, which isn't really ripping as it should, even if the DXY is at 100, it's certainly not going to be at 150 like the milkshake theory says. But I don't think saving in a melting ice cube is a good bet. If you're saving cash because you're worried about banking risk, that's a different thought. But I realize that it's not easy just to go out and buy an ounce of gold. And I realize that that's kind of empty advice to those who are worried about mortgages and tuition. For those who've already been stacking gold an ounce at a time or a gram at a time, I would again, and even, they're not clients of mine. I have no horse in that race, but I would say don't sell unless, like Turkey or Saudi Arabia, you have to. If you can hold on to that, you're going to be rewarded longer term, as you were rewarded in 2025 and even this year at the gold price. Even right now as we speak, if you were buying gold years ago, even these pullbacks aren't that scary. I think what investors need to get is more than just one YouTube interview from a gold bug, is they need to get conviction on why they own gold. They need to look at the pros and cons of gold. But if you look at the longer term history and the math of currency debasement, of credit cycles, and the longer term last laugh that gold always gets on debased paper money systems, which are clearly openly stressed right now. That's why we're seeing this desperation. That's why we're seeing these war headlines. You'll have the conviction to handle retracements or sell-offs like this, politically driven sell-offs, to save for the longer term. It's very hard to have that conviction if you aren't informed. And again, that won't come from just one guy who operates the largest private gold vault in the world selling you his book. You should be skeptical. But if you look beyond Von Greyerz or our partners and my founder, Egon Von Greyerz, if you look at Jeffrey Gundlach, if you look at Morgan Stanley, if you look at the central banks, if you look at the BIS, they're all doing the same thing that we're trying to tell you. Save in gold, spend in fiat, think longer term, not short term. And again, many who are listening aren't going to become a client of Von Greyerz, where our minimums are very high, but our message applies to anyone who's worried about the melting currency that they measure their portfolio in or they measure their wealth in. Some allocation to gold is essential. It's hard for those who are just trying to get by. I get that. And in addition to what I've talked about with gold, I can't call the end of a market. I can't time a market bubble. But like Jeremy Grantham and many others, or Jeffrey Gundlach, or Ray Dalio, or Michael Burry, or anyone who is actually managing risk in these markets, this is not a time to be chasing tops or doing the greed or fear trade. And especially in the risk asset markets, they could bluff higher for longer. I don't know. I think Powell will probably raise rates if he isn't, put in jail by the Trump administration or criminalized or arrested. It doesn't matter rates up and down. Longer term, this market is a bug looking for a windshield. It is a balloon looking for a needle. I think it will be private credit, possibly AI. The combination in the private sector of private equity and private credit will probably pop this, but I don't know. Something will. The debt levels, as I said at the beginning, are too untenable and unsustainable. They have been for a while, but what we're seeing right now with the geopolitical risks, in addition to the inflation risk and even the deflation risk, because deflation is certainly going to be, inflation creates its own deflation. As gas prices rise, as consumers buy less and our economy stalls. We could have an official recession, even though I think we've been in one for 4 years. We could have an official recession. It could set up a market crisis like it did in 2001. I do not know what the needle will be. This is not a time to believe that your 401k will look the same in 2 years as it did 2 years ago. This is not the time to rely on 60-40 stock bond portfolios or the US dollar being hegemonic forever. What we're seeing in the short term, I think, is lulling people into some real concern now I would not be high into U.S. markets, U.S. equities, and many, many very powerful hedge fund managers today, who I won't name, but they rhyme with some of the men I've mentioned already, aren't even buying U.S. equities. They're buying equities outside of the U.S. They're looking for real value. I think, again, long answer to a short question, Daryl, but yes, if you can afford grams or ounces of gold and you can think longer term, you will be rewarded in the next 10 years as you were in the last 10 years. And you've got to be conscious of the risk in your 401ks in a standard diversified credit equity portfolio. Those are very dangerous right now. And you've got to be prepared for deflationary forces in an inflationary environment. And you've got to be prepared for the end game when debt is this high. The U.S., I have no doubt, will debase its currency to inflate its way out of this debt, and they will use war and other things as a distraction or a war dividend, but it's not a long-term solution, regardless of how this war is resolved one way or the other.